Welcome back to another deep dive. Today, we're really cutting through some of the noise. We want to get you properly informed on a fascinating and honestly incredibly practical tool for understanding market movements. We've really dug into a whole stack of sources for this one, comprehensive guides, specific strategies, the works. And our mission today, it's to unpack the relative strength index, you probably know it as RSI, and really show you how it can be a shortcut to smarter decisions. Doesn't matter if you're just curious, prepping for a meeting, or looking to sharpen your market insights. When I first came across RSI, I admit the name, the math, it seems a bit intimidating. But if you start thinking of it more like a momentum meter for prices, its power really starts to click. It's almost like a speedometer for the market.
Yeah, that's a good way to put it. And what's truly fascinating here is just how much insight one single indicator can potentially offer. The Relative Strength Index, it was developed by J. Wells Wilder, and it essentially measures the speed and the change of price movements. It puts it all into this neat scale that oscillates between 0 and 100. Typically, it's calculated using 14 periods. Now, that could be 14 days, 14 hours, even 14 minutes. It really depends on the chart time frame you're looking at. But its core function, its real magic, is helping you identify overbought and oversold conditions. Think of those as maybe whispers, signals that a price reversal might be coming, moments when the markets may be pushed a bit too far too fast in one direction.
Okay, so like a speedometer. If it's measuring momentum, what do those numbers, that 0 to 100 scale, what do they actually tell us about the market's speed and direction? What does it mean for us practically?
All right, this is where it gets useful. How do we interpret these RSI values? The scale gives us pretty clear zones. First, you've got 70 to 100. This zone indicates an overbought condition. The interpretation here is that the price might have gone up too much, too quickly, could be overextended, and may be due for a pullback, or at least a pause. So it's often seen as a potential sell signal, or maybe a signal to be cautious about buying more.
Okay, so that's the high end. What about the middle?
Then there's 50. That's your neutral point, the midpoint. It basically represents a balance in momentum. Neither the bulls nor the bears are really strongly in control. Crossing above 50 often suggests increasing bullish momentum, while dipping below it suggests growing bearish momentum. It's a key level.
And a low end?
And then finally 0 to 30. This is the oversold zone. When RSI dips down here, it suggests the price might have fallen too far, too fast. Maybe the asset is getting undervalued. It implies that selling pressure might be exhausted and buying interest could soon step in. So it's a potential sign of a reversal back up, a possible buy signal.
So it's definitely not just a random number. It's telling us if the market car is maybe pushing the speed limit in one direction and might need to slow down or even, make a U-turn. That clicks.
Right, so we understand the zones now, overbought, oversold, neutral. The big question is, how do we translate that understanding into actual actionable decisions? Buy here, sell there. What are the specific signals we should really be watching for?
Okay, let's break down the primary signals RSI gives us. These are the ones that really help you pinpoint potential action points. First, the USI buy signals. One key signal is RSI crossing above 30. So imagine RSI has been down in that oversold territory below 30. When it climbs back up above 30, that's often a sign that the selling pressure is easing off. Buyers might be stepping back in. It's considered a bullish signal, often a good potential entry point, especially after a clear downtrend.
Okay, crossing back out of oversold. What else?
Then there's bullish divergence. Now, this one is a really quite insightful. It's when the price makes a new low, but the RSI indicator makes a higher low. So price goes lower, but momentum doesn't confirm it.
Exactly. RSI is basically whispering, hey, even though the price just dropped again, the force behind that selling is actually weaker than before. It signals a strong possibility of a reversal upwards. It's a favorite for traders looking to pick potential bottoms, sometimes called bottom fishing.
That's a subtle but powerful one. Anything else for buys?
Yes, also RSI holding above 50 in an uptrend. If you're already in an uptrend and RSI consistently stays above that 50 midpoint, maybe dipping toward it but bouncing off, that confirms the trend's underlying strength. You can use this more as a trend continuation signal, maybe to add to a position, or just confirm it's okay to stay long.
Got it. So what about the sell side, the RSI sell signals?
It's pretty much the mirror image. First, RSI crossing below 70. So RSI was up in overbought territory above 70. When it drops back below 70, it suggests the buying frenzy might be cooling off. It's a bearish signal, often seen as a potential exit point after a strong rally, indicating momentum is shifting downwards.
And I bet there's a bearish divergence too.
You got it. Bearish divergence. This time, the price makes a higher high, but the RSI makes a lower high. Again, RSI is giving you that early warning. Even though price is pushing up, the buying power behind that push seems to be fading. This points to a potential reversal downwards, a risk. It's often used to spot trend exhaustion before a significant pullback or correction happens.
So price looks strong, but RSI says maybe not for long.
Precisely. And finally, RSI falling below 50 in a downtrend. Similar to the bullish version, if RSI consistently stays below 50 during a clear downtrend, it just confirms that bearish momentum is still in control. This could be used as a signal for initiating or holding short positions, or simply as confirmation to stay out of long trades.
Those divergences, both bullish and bearish, they sound like a real aha moment. That difference between just looking at price and looking at the underlying momentum, that seems crucial. Are there any common traps people fall into when they first start looking for divergences? Ways they might misinterpret them?
Oh, absolutely. A big one is seeing what you want to see, forcing a divergence where it isn't really clear or strong. Another is acting too soon. Divergences are warnings, but they can sometimes build for a while before the price actually turns. So waiting for some confirmation like a price pattern or a break of a trend line is usually much safer than jumping in just on the divergence itself.
Right, confirmation is key. Okay, this is great theory, but let's get practical. Once you understand these signals, how do people actually put RSI to work? Are there specific common strategies traders and investors use?
Yeah, moving from signals to strategy is the next step. And connecting this to the bigger picture, it's really about using RSI as part of a toolkit, not just relying on it alone. It's powerful, but its real strength comes when combined with other analysis or specific frameworks. So here are a few common strategies. 1. The traditional overbought, oversold 30-70 strategy. This is the classic, the one most people learn first. The idea is simple. Look to buy when RSI drops below 30, oversold, and look to sell or take profits when it goes above 70, overbought. This tends to work best in markets that are moving sideways, range-bound, where prices are bouncing between support and resistance.
But you mentioned a risk with this one earlier.
Yes, exactly. The big caveat here is that in very strong trending markets, RSI can stay overbought above 70 or oversold below 30 for a long time. If you just blindly sell every time RSI hits 71 in a massive bull run, you can leave a lot of profit on the table. So context is crucial.
Okay, so classic, but use with caution in strong trends. What's next?
2. The RSI Divergence strategy. This focuses specifically on spotting those divergences we just talked about. Looking for bullish divergence, price lower low, RSI higher lows, as a potential buy signal, and bearish divergence, price higher highs, RSI lower highs, as a potential sell or short signal. This is really excellent for trying to spot potential trend reversals, those turning points.
Seems more proactive than just waiting for 30 or 70.
It can be, yes. Then 3, RSI combined with a moving average. This adds a trend filter, which helps address that issue with the classic 30-70 strategy and trends. For example, you might only take a buy signal from RSI, like crossing above 30, or a bullish divergence, if the price is also trading above a key moving average, like the 50-day or 200-day MA. This helps ensure you're trading with the larger trend, not against it. Adds a layer of confirmation.
Layering signals. I like that. Any others?
One more interesting one is the 4, RSI breakout strategy. You can actually draw trend lines directly on the RSI indicator window itself, just like you do on the price chart. Sometimes the RSI will break its own trend line before the price breaks its trend line. This can act as an early warning, an early signal of a potential shift in momentum and a possible price breakout to come.
Drawing trend lines on the indicator itself. Okay, that's clever. So it really sounds like the best approach isn't about picking just one signal, but layering them, combining them with price action or other indicators for more confidence.
Exactly. Confluence is the name of the game, finding multiple reasons that agree.
Now, every tool, no matter how powerful, usually has its quirks, its limitations. You mentioned the issue with strong trends already. What else should we be really cautious about when we start relying on RSI?
That's a really important point. Understanding the limitations is just as crucial as understanding the signals. So besides the false signals and strong trends, which we've covered, another key thing to remember is that RSI is a lagging indicator.
Meaning it's based on past prices.
Correct. It's calculated using historical price data. So it's telling you about momentum that has happened. It's great for confirming a move that might be underway or signaling exhaustion, but it's not fundamentally predictive. It follows price. It doesn't lead it in the strictest sense.
So don't expect it to be a crystal ball.
Definitely not. Use it more for confirmation than prediction. And third, different results on different time frames. An RSI signal that looks really strong on a 5-minute chart might be completely insignificant noise on a daily chart. Or an oversold reading on a daily chart might happen while the weekly chart still looks very strong. It's absolutely critical to align the RSI timeframe with your trading or investing horizon. All right, day trading, swing trading, investing. Use the appropriate chart.
That makes perfect sense. You need the right tool for the right job and the right time frame for the right strategy. So given these limitations, the lagging nature, the time frame issue, the strong trend problem,
Yeah.
how do we use RSI effectively? What are your top tips for making it work?
Good question. Okay, some key tips for using RSI well. First, always use it alongside price action. Don't trade RSI in a vacuum. Look at the actual candles. Identify clear support and resistance levels. Does the RSI signal line up with a bounce off support or rejection at resistance? That adds weight.
Price context is king.
Absolutely. Second, consider adjusting your view in strong trends. Like we touched on, in a powerful uptrend, maybe you start thinking of the 40-50 RSI level as the buy the dip zone rather than waiting for 30. And maybe 70-80 isn't an automatic sell, but just a take notice zone. Conversely, in a strong downtrend, maybe the 50-60 zone is your sell area, and 30 isn't necessarily a buy signal yet. You adapt the zone slightly.
Adapt the levels to the trend environment. Smart.
Third, always backtest. Whatever RSI strategy you're thinking of using, test it on historical data for the specific asset and time frame you plan to trade. What works for, say, Bitcoin on the 4-hour chart might not work for Apple stock on the daily chart.
No one-size-fits-all strategy.
Not at all. And finally, remember, you can adjust the RSI period setting itself. The default is 14. Using a shorter period like 7 makes it more sensitive, faster, but potentially noisier. A longer period like 21 makes it smoother, slower, fewer signals, but potentially more reliable ones. You can experiment to see what fits your style.
Tweaking the settings. Okay. Can you give us a concrete example of putting this together?
Sure. Let's imagine you're looking at, say, Microsoft stock on a daily chart. Maybe RSI dips down to 25. That's oversold. At the same time, you notice the price is right at a major, previously established support level. Okay, two factors align. Then you look closer and see bullish divergence. Maybe price just made a slightly lower low, but the RSI made a higher low. That's 3 factors. That combination gives you much higher confidence to consider a buy, maybe you're placing a stop loss just below that recent low.
Okay, that confluence idea again.
Exactly. Or, on the flip side, maybe RSI is way up at 78. Price is hitting a known resistance level. And you spot bearish divergence forming. That combination might make you think about taking profits on a long trade or tightening your stop loss, or even considering a short position if other factors align. It's about building that case.
Building the case. I like that framing. Okay, this is fantastic. So now we've got the fundamentals, the signals, the strategies, the limitations. Let's really dig into how this plays out in practice across different time frames. What does this all mean for you, the listener? Whether you're looking for those quick intraday moves or maybe swing trading over wicks or even investing for the long haul. Let's start with the fastest pace, intraday trading. For folks looking to get in and out within the same day, how does RSI fit into that world?
Right, intraday trading with RSI. It's all about speed and precision. You're using the indicator to find quick entry and exit signals within that single trading session. Because RSI tracks momentum so well, it's great for spotting those rapid reversals from overbought or oversold zones on, say, a 5-minute or 15-minute chart. It can also help confirm quick momentum breakouts or highlight those divergences that often lead to sharp, short-term price flips. It really demands focus.
And settings. Still RSI 14 for intraday.
The standard 14 period is definitely usable, especially on maybe a 15-minute chart. But for even faster signals, some intraday traders might use a shorter setting, like RSI 5 or 7.
Faster, but maybe more noise.
Exactly. You get more signals, but potentially more false ones too. You have to filter more carefully. Or you could go the other way, use a slightly longer period, like 21 for fewer, maybe more reliable, but slower signals. It's a trade-off.
Okay, so let's talk strategies for intraday. What works?
All right, let's walk through a few focused intraday approaches. Strategy 1, the classic overbought, oversold reversal. This works best when the market is chopping around sideways in a range on that intraday chart. For a buy signal, you're watching for RSI to dip below 30, oversold, while the price is near a clear intraday support level. The trigger isn't just RSI hitting 30, it's when it crosses back above 30, your exit. Maybe when RSI gets back to the 50 or 60 level, or when price approaches the top of the intraday range.
And the sell side.
Sell signal, the opposite. Look for RSI pushing above 70, overbought, near an intraday resistance level. The entry is when RSI crosses back below 70. Exit targets could be RSI hitting 50 or 40, or price reaching intraday support.
Simple, but needs that range-bound condition.
Yes, crucial. Now, strategy 2, RSI divergence combined with price action. This one often has a higher accuracy, especially intraday. For a buy setup, bullish divergence, You spot price making a lower low, but RSI makes a higher low. Momentum is disagreeing with price. You find a clear support zone nearby. You wait for confirmation of strong bullish candlestick pattern, like a hammer or an engulfing candle right at that support. Your entry is on the close of that candle. Stop loss goes just below the recent low, and you target the next resistance, or maybe when RSI gets near 60-70.
Waiting for that candle confirmation seems vital intraday.
It really is. For the sell setup, bearish divergence. Price makes a higher high, RSI makes a lower high. Buying momentum is fading. Mark your resistance zone. Wait for a bearish candle confirmation, a shooting star maybe. Enter on the close of that candle, stop above the high, target support or RSI down near 30-40.
Okay, divergence plus confirmation, powerful. What else?
Strategy 3. Using RSI for trend bias, maybe with a moving average like EMA or VWAP. This strategy is about filtering your signals to only trade with a dominant intraday trend. You use something like a 50-period EMO or the VWAP, volume-weighted average price, very popular intraday, to gauge the trend. If price is above the EMA VWAP and RSI is generally holding above 50, you only look for buy signals. Maybe RSI dips towards 40 or 50 and bounces. That's your buy the dip signal within the uptrend. If price is below the EMA VWAP and RSI is below 50, you only look for sell signals, perhaps on rallies towards the 50-60 RSI level that fail.
That sounds like a really sensible way to filter out noise and avoid fighting the intraday flow. Makes a lot of sense. Now for intraday, speed is everything. What other tools would you absolutely recommend combining with RSI to increase confidence quickly?
Yeah, layering is even more important intraday. Definitely consider VWAP. Like I mentioned, great for seeing where potential institutional activity might be happening. EMAs. Faster exponential moving averages, like a 9 or 20 period, and provide quick trend confirmation or dynamic support resistance. Support resistance levels. Identifying clear horizontal price levels is absolutely crucial for entries and exits. And candlestick patterns. They give you those precise moment-in-time entry triggers. A hammer, an engulfing pattern. They tell a story right when you need it.
Got it. So build that confluence of signals. Any final key tips specifically for intraday RSI users?
Yes, a few crucial ones. 1. Never ever trade RSI alone. Always seek confirmation. 2. Avoid overtrading. RSI can give lots of signals on short time frames. Be selective. Filter ruthlessly. 3. Timing matters. Often the best volatility and clarity is during specific market hours like the open or maybe the hour before the close. In the Indian market context, for instance, 9:30 a.m. to 11:30 a.m., maybe 1:30 p.m. to 2:30 p.m. often see good movement. 4. Risk management. Always use a stop loss and aim for a positive risk-reward ratio, ideally at least 1 to 1.5 or better. And 5, be wary of major news events or extreme volatility spikes. Indicators can get whipsawed around. Sometimes it's best to just sit out.
Excellent practical advice. Okay, let's shift gears slightly. What about swing trading? For those looking to hold positions for a few days, maybe a few weeks, capturing those larger price moves. How does RSI fit into that picture?
Right, swing trading. It's a different rhythm. You're aiming to capture those swings that typically last anywhere from, say, 2 days up to maybe 10 days, sometimes even stretching to 2 or 3 weeks. RSI is a fantastic tool here, especially when you combine it with daily chart analysis looking at price action, trend lines, and key daily support and resistance levels. It helps time entries near the start of a swing and exits before it potentially reverses.
And the settings for swing trading, still 14, or do you adjust?
RSI 14 on the daily chart is a very solid baseline for swing trading. It offers a good balance. If you wanted slightly faster signals, maybe capturing shorter swings, you could try 7 to 10. If you prefer smoother, more stable signals for longer swings, maybe 21. But the time frame is key. The daily chart is usually best for your primary entry exit signals, while maybe glancing at the 4-hour for refinement or the weekly chart for the bigger picture trend context.
Daily chart focus. Got it. So what are some effective RSI strategies tailored for swing traders?
Okay, let's look at swing strategies. Strategy 1, the classic RSI reversal from overbought, oversold. Similar to intraday, but on the daily chart and looking for bigger zones. For a buy setup, you see RSI dip below 30 on the daily chart, and importantly, price hits a major daily or weekly support zone. The entry trigger is RSI crossing back above 30, ideally confirmed by a strong bullish daily candle. Exit targets might be near the RSI 60-70 zone or the next major resistance level.
And selling.
Sell setup. RSI pushes above 70 on the daily, price hits a major resistance zone. Trigger is RSI falling back below 70, confirmed by bearish price action. Exit near RSI 40-30 or the next support. Again, this works best in corrective phases or sideways markets, less so in powerful, established trends.
Okay, the classic fade, but on a bigger scale. What about divergences for swing trading?
Strategy 2, RSI divergence for reversal swings. This is a personal favorite for swing trading, honestly. It can give you great clues about potential trend shifts. Bullish divergence. Daily price makes lower lows, but daily RSI makes higher lows. Combine this signal with price testing, a strong support zone. Look for a bullish reversal pattern on the daily candle, like a hammer, morning star. Entry on confirmation. Stop below the swing low. Target a previous swing high or key resistance.
Seems like a high probability setup if it aligns.
It can be. Bearish divergence. Daily price makes higher highs, RSI makes lower highs. Combined with a major resistance zone, look for a bearish daily reversal pattern. Entry on a breakdown confirmation. Stop above the recent high. Here, adding confirmation like a break of a daily trend line or significant volume on the reversal day adds a lot of confidence.
Excellent. Any strategies for trading with the swing trend?
Yes. Strategy 3. RSI trend zone swing trading. This is specifically for trading pullbacks within an established trend, using RSI zones differently. In a clear uptrend on the daily chart, RSI often oscillates between roughly 40 and 80. So you look to buy the dips when RSI pulls back to that 40-50 zone, especially if price is also pulling back to a key support level like a trend line or maybe the 21 or 50-day EMA. You then look to exit or take partial profits as RSI approaches the 70-80 overbought zone within the trend.
So buying weakness within strength.
Exactly. And in a clear downtrend, RSI might stay mostly between 20 and 60. You'd look to sell the rallies when RSI bounces up to the 50-60 zone, especially near resistance or a falling EMA. Exit targets could be RSI approaching the 30-20 oversold area or the next support level. This works well with Fibonacci retracements too to identify those pullback levels.
That's a very practical way to use RSI in trending markets. Any other swing strategies?
One more. Strategy 4. RSI breakout confirmation. Just like intraday, but on the daily chart. Draw your trend line on the daily RSI indicator. When RSI breaks that trend line, it can signal that momentum is shifting before the price confirms a breakout. Your entry could be triggered by the RSI break, but ideally confirmed by a strong price breakout candle on the daily chart. Pairing this with volume analysis or chart patterns like triangles or flags makes it much stronger.
Okay, quite a few options there for swing traders. Again, thinking about confluence, what are the absolutely crucial tools you'd advise combining with RSI for these higher probability swing trades?
For swing trading, the layers become even more important because you're holding longer. Definitely combine RSI with major support and resistance levels, identified on the daily and weekly charts. These are your key battlegrounds. Trend lines, both on price and potentially on RSI, crucial for defining the trend and spotting breaks or divergences. Volume. Is volume confirming the price move? High volume on a breakout or a reversal adds huge conviction. Low volume suggests caution. Key moving averages. The 21 EMA, 50 EMA, maybe even the 200 SMA on the daily chart act as dynamic support, resistance, and trend filters. Daily candlestick patterns. Provide those precise entry triggers at your chosen levels. And Fibonacci levels. Great for identifying potential pullback depths and extension targets that can align with RSI signals.
Building that multifaceted picture, can you walk us through a hypothetical swing trade example?
Sure, let's take an example, say TCS SOC on the daily chart. Imagine RSI falls down to 28, that's oversold. At the same time, you see the price is testing a key support level around 300 and 450 that has held multiple times before. Then the next day, RSI starts to hook upwards and crosses back above 30. And on that same day, price forms a clear bullish engulfing candle right off that support. That's a strong confluence. You might consider entering long, maybe around 3,500, placing your stop loss below the recent low, perhaps at 3,400. Your targets could be the next resistance level, say 3,620 and 3,740, maybe taking some profit off the table when RSI gets up near 68 or 70.
That paints a clear picture. Fantastic. Any final quick tips specifically for swing traders using RSI?
Yes, definitely. 1, again, never use RSI alone. Confluence is your friend. 2, be extra careful trading RSI extremes against a very strong established trend. Wait for clear confirmation of a reversal. 3, use alerts. Set alerts on your platform for when RSI crosses 30 or 70 on your target stocks so you don't have to stare at charts all day. 4, consider using the daily chart for the main signal, but maybe zoom into the 4-hour chart for more precise entry point once the daily signal triggers. 5, aim for a good risk-reward ratio, at least 1.2 for swing trades, to make the winners count. And 6, consider using a trailing stop loss, especially as a profitable trade progresses and RSI starts approaching the opposite extreme, overbought if you're long, oversold if you're short, to lock in gains.
Trailing stops, good point for capturing more of the swing, but what about the limitations again? Anything specific to swing trading?
The main ones still apply. RSI lags, so confirmation is safer than anticipation, especially if the market is moving fast. Overbought, oversold signals can definitely be misleading in strong trends if you don't filter them. And RSI divergence can sometimes persist for several candles, even days, before the price actually turns. So again, patience and waiting for confirmation before entering is key. Don't jump the gun just because you see divergence forming.
Patience and confirmation. Got it. Okay, we've covered the fast pace of intraday and the medium-term rhythm of swing trading. Now, what about the long game? For investors holding positions for months, even years, focusing on fundamentals, is RSI even relevant? Or is it purely a trader's tool?
That's a great question, and the answer is yes. RSI can be very relevant for long-term investors, but in a different way. For investing, where you're focused on value, growth, compounding over years, RSI isn't your primary decision driver like fundamentals are. But it can be an incredibly useful timing filter. It can help you time your long-term entries more effectively, maybe avoid buying into a frenzy at the top, or identify potentially attractive entry points during market dips or corrections for stocks you already like fundamentally.
So less about should I buy this company and more about when might be a good time to buy this company I already like.
Exactly. It's a tactical overlay on a strategic decision. Remember, RSI measures momentum, not intrinsic value. So use it to refine timing, not as the sole reason to invest.
Makes sense. What about RSI settings and timeframes for long-term investing?
For investing, you definitely want to filter out the short-term noise. So the standard RSI 14 is still fine, but some investors prefer a longer, slower setting like 21 or even 30 to focus only on major momentum shifts. But the absolute key here is the time frame. You must use weekly or even monthly charts for RSI signals when investing. Daily chart signals are just too short-term for a long-term perspective.
Weekly and monthly charts. Got it. So how does RSI strategy adapt for this long-term view?
It becomes less about quick reversals and more about identifying major strategic opportunities or risks. Strategy 1, buy the dip using RSI oversold on the weekly chart. This is probably the most powerful application for long-term investors. You look for RSI dropping below 30 on the weekly chart for a stock whose fundamentals you already believe in long-term. This signal becomes incredibly potent if it coincides with the price hitting a major long-term support zone or maybe the 200-week moving average. Think market crashes, deep corrections, like the COVID crash in March 2020. Many high-quality stocks saw their weekly RSI go below 30. The entry trigger is usually when RSI starts turning up and crosses back above 30, signaling the panic might be easing. You buy with the intention of holding for months or years. Buying quality on extreme weakness timed with RSI. That sounds powerful. It really can be. Strategy 2. Add on weakness using RSI between 30-50 in a bullish trend. This is for adding to existing long-term positions. If a stock you own is in a solid long-term uptrend, based on fundamentals and maybe the weekly chart trend, and the weekly RSI dips into the 30-50 zone during a pullback, especially near support or a key moving average, that can be a good signal. It's a reasonable time to add more shares. It's a structured way to buy the dip within a winning investment.
So scaling into winners.
Precisely. Strategy 3, avoiding expensive buys using RSI overbought. This is more about risk management. If the weekly or monthly RSI on a stock you're considering is way up, maybe above 70 or even 80, it's a warning sign. It suggests the stock might be caught up in hyper euphoria. It doesn't mean sell immediately, but it might mean it's not a good time to initiate a large new position. Maybe wait for RSI to cool off, for a price to consolidate. It helps avoid buying at potential tops. Think about some tech stocks before major corrections. Their weekly RSIs were often extremely high.
Using RSI as a don't chase signal.
Yeah, a discipline tool. And finally, strategy 4. Long-term RSI divergence for major trend reversals. Spotting a bullish divergence, lower price lows, higher RSI lows, on a weekly or monthly chart, especially after a prolonged bear market, can be a very early signal of a potential major bottom and the start of a new long-term uptrend. If you combine this kind of long-term technical signal with supportive changes in the macroeconomic environment, like inflation peaking, central banks shifting policy, it can be a powerful tool for value investors trying to identify those really significant turning points.
Wow, so RSI divergence on a monthly chart, that's looking at the really big picture shifts. This makes it clear RSI isn't just for traders, but for investors, combining it with other tools seems absolutely essential. What are the must-haves to pair with long-term RSI analysis?
Oh, absolutely essential. For investing, you must combine weekly, monthly RSI with fundamental analysis. Is the company actually strong, profitable, growing, good management, competitive moat? RSI tells you nothing about this. Fundamentals come first. The 200-week moving average. This is a huge one for long-term investors. It often acts as major support during bear markets or deep corrections. An oversold weekly RSI near the 200-week MA is often a potent buy zone for quality stocks. Valuation metrics, things like price to earnings, P/E ratio, price to book, etc., help you assess if the stock is reasonably priced. Even if RSI is low, you don't want to buy a value trap. Volume patterns and accumulation. Are institutions potentially buying during the dip accumulation? Look for signs of this on the weekly chart volume. And weekly, monthly candlestick patterns for confirmation right at those potential turning points identified by RSI.
Fundamentals first, then use RSI and other technicals for timing and context.
That's the framework. Think about Infosys, INFY again, on the weekly chart during that March 2020 crash. Its weekly RSI fell below 30. Price hit 510, which was not only a huge long-term support zone, but also right around its 200-week moving average. Crucially, its fundamentals were still strong. An investor who recognized this confluence and bought as RSI turned up, holding until maybe RSI got significantly overbought again, around 70, 75 in early 2022, could have seen returns well over 100% in less than 2 years. That's RSI aiding long-term entry timing.
That's a compelling example. Any final tips for investors using RSI?
A few key ones for the long-term mindset. 1. RSI is a supplement, not a substitute for fundamental research in a macro view. 2. Embrace the buy fear, sell greed mentality. Weekly RSI below 30 often reflects peak fear, potentially a great long-term entry point for solid companies. 3. Use RSI on broad market indices like the Nifty 50 or S&P 500 on weekly monthly charts to get a sense of overall market sentiment and potential major turning points, which can help with asset allocation. 4. Consider scaling in. Don't feel you have to buy your entire position the moment weekly RSI hits 29. Maybe buy in thirds as RSI turns up and price confirms. And 5. Use alerts for weekly RSI levels on your watchlist stocks. Helps you stay patient but ready for opportunities.
Scaling in, using index RSI, great practical tips, but the limitations must still apply even more so long-term.
Absolutely. The big ones for investors. RSI tells you nothing about the quality of the company or its future prospects. A stock can have a low RSI because it's genuinely a failing business. Also, in massive secular bull markets, weekly RSI can stay above 50, even above 70, for years. And in grinding bear markets, it might struggle to get above 50 even if the company's okay. So the best approach truly is to use it as a risk management and timing tool within your broader investment framework, not as the sole reason to buy or sell anything long-term.
Fantastic. What a comprehensive look. So whether you're diving into the charts minute by minute for intraday trades, looking to capture those multi-day swings, or strategically building a portfolio for the years ahead, it seems RSI offers this really unique lens on market momentum. But the recurring theme, the big takeaway, is that its real power, its true practical value, emerges when you skillfully combine it with other analysis, other tools, price action itself.
Exactly. We're constantly bombarded with financial news, opinions, data, just sheer noise. And maybe the real strength of RSI isn't just finding those buy or sell signals. Maybe it's about helping you cut through some of that noise. Focus on the underlying shifts in momentum, the ebb and flow of buying and selling pressure that actually drives the market. So the question for you, the listener, as you move forward is, how will you use this deeper understanding of momentum, this clarity RSI can offer, to refine your own approach, your own decisions in the market? How will you use it to see beneath the surface?